Okay, basically, guys, another thing which I wanted to show you again, it's coming back to valuation perspective. Look, P ratio for Cisco, again, that ratio which tells us how much money people are paying for this $1 of profit. Here we can see that if we take from 2004, probably the highest level was here, 29 times. And the lowest was in 2012, which was 9.7 times. During the last 2 years, it was 16 times, 15 times, 13 times, 11 times, 12 times, 11 times, okay? Currently, it's 13 times. Now, this is annual average. And remember that during the year, on the same type of earnings, the price changed. It went up and it went down. That's why I always calculate how much in our average on the maximum price. So what's the P ratio was when the price went to the highest point, okay? And what's the P ratio was when the price went to the lower level, okay? And the way we do it, we calculate through this specific table. The way we do it, we put 5-year highs. Okay, just a second. It seems like your screen is a bit just updating. Okay, you can see that 5-year highs, $30, $32, $39, $49, and $58. We add them together and then calculate the average, divide by 5. Then we do exactly the same with the 5-year lows. So we take the lowest price of that stock for the last 5 years, and again add them together and calculate the average low. So we can see that in average the price of the stock moves from $30 to $41. Okay, but we know that that's the actual income for that specific period. So we add them together again 5 years and calculate the average income, like earnings for that, and then we divide, and we look, okay, in average, people paid $41 for that share. So how is it compared to the earnings? So 41 divided by 2.5, it comes to 16. So when everything is rosy, people believe in this company. And remember, like during the year, emotions change. One good report, another bad report, right? When somebody tells something good, promise them something, people more positive about this company, they're paying higher price. Okay, so the average high, it was 16.5 times. Now, when everything is bad, when directors come and tell something not good about their prospects and etc., about products, delay something, losing customers, etc., people pay less. And in average, it's 12 times. Okay, the way we calculate it, we take the low average and then divide by 2.5, which is average earnings, and we get to 12 times. So the way after that we think, okay, what if in the future we are going to be between exactly the same valuation? Because we took 5-year period. It can be kind of used as a, you can take 10 years if you want. 5 years is already pretty good. Now, what we do, if we believe that the company is going to make amount of money in the future, which they promise, okay, and Cisco promising that they're going to make $4. That was from value line. And we believe that if they're going to make that amount of money, and also in addition to that, people believe in it and they're happy about this company and etc. So how much they're going to pay. So if that was average price earning ratio, so we multiply that and we get $66. So we believe that during next 3 to 5 years, which where they're going to make this amount of money, it's going to get at the highest point in average $66. Okay, at the moment it's $40. Now, also we need to calculate what's the risk, okay, and the minimum price. So we know that it's 12.1, and we take actual earnings, okay, and we take actual earnings which were last year, $3.1. At the moment, this year is already $3.2. They're already higher. So we take the last year earnings, which were actual, and multiply by that multiple, and we get $37.61. That's where our risk. So if we take that average 5 years, when everything was very bad, people paid in average, they would be paying this amount of money, 37. Yes, of course, it can go lower, but in average, it's something like that. And the current price is $40. So when you calculate your risk and reward, so from the $40 level, you can drop $2.4, which is close to about 6-7%, right? Or it can grow to $66, which gives you roughly 60% growth. So we see that it's limited risk here and a higher reward in that particular case. In addition, you get dividends. Okay. That's how I evaluate my personal risks in this particular case. And I can see this is the range. So what I do, I believe that about 30% of the time, 1/3 of the time, it's going to be close to the low part of the valuation. 1/3 of the time, it's at a higher level, and 1/3 somewhere in the middle, right? So in this particular case, I got these three ranges. And from 37 to 47, that's why I buy. From 47 to 56, I will be holding this position. And above 56, I will be exiting this position, okay? Unless something didn't change fundamentally, okay? That company might improve themselves, and that price already is pretty good price to hold. They start decreasing. That's what I'm going to make, and the valuation will change as well. Okay. If we based on this table, we have 52 points. This is a table provided by TICM, the Investment Cloud Network, and what they do is gets the highest number. So this company is really undervalued compared to the previous performance which this specific company had. Now, guys, I already skip the quality calculation, but I wanted to ask those who already know how to calculate and how to evaluate the company. Express your opinion, guys. What do you think? Is it a quality company or not quality company? Put in chat. You can put in points. You can tell it like that. Is it a quality, good company or bad company? What do you think yourself? Basically, I already showed you that it is undervalued, definitely. Okay, Olga is writing very good company. What the rest? Ari, David, Jean, Katerina, Maria, Max, Nano, Michal, Williams. What do you think? Man, I like it. Jean, not sure. Okay, 4x4 has a good potential. Okay, good. Okay, great. Yeah, it is a good company. So it gets 4 points. 4 is the maximum. Okay. The weights lost, it's lost on trend. I showed you that I prefer when company is growing more than 10%. This company grows in a range of 5-7% in that specific range. It's still good growth for a company which like 170 billion in capitalization, but still I put less points. And also I had 1 point, 2 points I deducted from management because during this specific year we have a small drop in revenue, and that's why I kind of but still it's got 14 total scores, which gives us ideal company from quality perspective. And if you think about it, in general for Cisco, they have multiple products. Even during this difficult time, they still manage to perform better than expected, and because a lot of businesses postponed their purchasing decision. But the question is, what happens after they make their mind? Those clients who postpone the decision. So if you don't buy your computer for extra 6 months, what happens after that? You come and buy. So the volume is going to be much higher. The question is, what company will get that volume? And if we look at the market, we will see that Cisco, one of the best providers in this particular industry, which can support businesses in different directions. It doesn't really matter what you choose. This is, again, guys, my opinion. You might have different opinion. And remember that each investment decision which you're going to make, you're going to put your own money. So basically, whatever I am expressing you tonight is personal opinion. I definitely tell you not to put any money into that. If you like this company, I ask you to analyze more, to download value line report, to go to different sources, to read more about it. And then if you're happy with that, allocate like a portion of your capital on that. But knowing what's your plan, if you're buying tonight, when are you going to exit? Okay, if you bought it and it starts dropping down, what your course of actions you're going to have? Okay, which the questions are very, very important. All right. By the way, this is the Estimize website, and just a second, it seems like a delay in your page. So this is Estimize range, and you can see the green dot where the actual earnings are, and that's where you can see Cisco is usually like just in exact place, okay, or sometimes higher. And this last quarter, they reported higher than expected earnings, but still the price dropped a lot because for the future, they told that they're going to have less revenue than they expected. Okay, this was what affected the price. And also, if we look at ownership right now, 74% of this company is owned by institutional investors. Okay, it's also quite good level. It means that big institutions believe into this company and they move money into that particular business. And the rest of shares are traded on the open market among like other businesses. Okay, guys. How is clear for you fundamentals of this specific company? Put from 0 to 10. And if it's all clear, we'll continue with technical analysis. Okay, insider transactions, that's where how many insiders they sell and buy. So you can see that they sold close to 5% during that